Hello, hello. Richard Amoydo here, co-founder of Investor Next Door Club. So happy to have you on this masterclass tonight. We're going to talk about how do you spot a scam. Those of you that are attending here just live, feel free that you can drop in any comments or any questions you may have. I'll check those at the very end. I won't do it in between, but we've got a lot to cover in a short amount of time. Those of you that are club members with us, welcome. And those of you that are guests seeing this for the first time, I want to welcome you because this is our pleasure to be able to offer these free master classes, really just to create awareness and help educate people on what's out there in the investing world, whether it's real estate or non-real estate. At Investor Next Door Club, we put a heavy emphasis on real estate because we believe that it is a pathway to wealth. It's been proven to do that over the decades, but very few people ever really have access to it. But in today's world, people are exposed to a lot of different things thanks to the internet. Things can spread pretty quickly, but even things spread word of mouth also. And its question is, is this legit? Is this real? How do I tell? How do I vet it, right? And you should always be careful. You should always ask a lot of questions. That's why our members that are in our community, they have a trusted, safe place they can come when they come across things that are outside of our own company, outside of our own organization. They can check on things. They can talk to experienced people, which is why, we spend a lot of time on how to spot a scam. And so tonight we're just going to be discussing some key things to pay attention to on how do you spot an investment scam. We want you to be able to protect your capital because that protects your future. We're going to be talking about things like the Howey test, the Ponzi red flags, what are credible investment clubs? And we want you to be able to think like a regulator so you can build ownership the right way. We do believe that ownership is what provides freedom, and you should be able to own your freedom. And the only way to do that is to protect your seed, is to protect your capital. Now, smart investors avoid losses before chasing gains. Anytime that we do something in real estate, we know what our gain is going to be before we actually purchase. Sometimes you'll hear, your profit is made on the purchase. Now, it doesn't mean you recoup your profit on the purchase, but you know what your back end is going to look like, and you know what's going to be happening in between because you've done your homework, you've done your math, you know the numbers, and all you have to do is operate it. But, bad operators, not bad markets. Something to consider is you got to know this, right? Most people don't lose money to the market. They lose it to people who shouldn't have had their money in the first place. These are people that had bad intentions or they just had bad experience. There's a number of things that can go on with this. Now, education is your first line of defense. If you can't explain how returns are generated, you don't yet own the decision, right? You don't really know. Someone else is controlling that. Like the person who has more knowledge and experience than you, they can control that conversation. So you need to know what questions to ask. And fraud hides in complexity and urgency. How many times have you heard, no, you got to get in now. This is the time. This is when it happens. This is only going to happen one time. Listen, trends do happen. And, there's trends that we're seeing right now, and they're legitimate trends. You can't base a long-term business model on that, but you can plan for those opportunities while you're working other more conservative strategies. But anything that feels like it's too proprietary, to question or too urgent to verify is exactly what should be verified. You don't want to get lost in the weeds of something and someone else kind of glossing over it. You need to be able to understand it. There's not a deal that I work on that I couldn't explain to my grandmother. Okay. So now she may not understand everything, but she will understand the general premise of what we're doing and how it actually generates money and how it actually provides value to the marketplace. So bottom line, if you don't understand it, you shouldn't invest in it. I'm pro crypto. There's a lot of bad crypto out there, my personal opinion. And most people jump into crypto on someone else's opinion. They don't actually verify anything like what is built around this coin or this token, whatever it is. And they make a knee-jerk reaction because there's this fear of loss that kicks in. Listen, you have time to do your due diligence. And if something lands on your desk and you've only got like 3 days to make a decision, that's going to add a lot of stress to you and maybe even a lot of problems or pain in the future. So my personal opinion, is there's always a next deal. Now, there's not always a next Facebook. There's not always a next Tesla. There's not always a next whatever, OpenAI. But all of those things started years and decades before they became really open to the public. So there was a lot of time for those to grow and develop. When you're looking at real estate or you're looking at other type of investment opportunities, just know they're probably not a unicorn, but if you make a knee-jerk reaction, it could feel very, very heavy in the future. Now, there's a legal standard out there that defines what a security is. And maybe you don't know what securities are. Some of you have 401ks. Your 401k invest in securities. It goes into the index markets, maybe it buys some individual stocks, whatever. But they're buying in publicly traded companies. Those are securities. But there are a lot of securities in the private market. What most people don't realize is that the Security Exchange Commission manages way more private securities transactions than what's happening in the public markets. So you've got this. If all four prongs are present, it's an investment contract. And you must comply with U.S. securities law, even as a private company. I learned this over 20 years ago, and I was grateful that I had a mentor and someone that guided me to make sure I raised capital in the proper way for our funds. And you just need to understand that a security is any investment contract, including stocks, bonds, fund interest, many opportunities, that may not call themselves securities are actually securities. So you're going to think like a little bit like the SEC before you think like an investor. What people that are promoting things want you to think like is think like an investor. Think about what you're going to lose. But here's the thing. If you don't do your homework and you enter a bad deal, whose fault is that? Yes, the operator did a bad thing. But at the end of the day, you're responsible for protecting your nest egg and protecting your future. So we're going to talk a little bit about the things as it pertains to the Howey test. You're going to be more knowledgeable about this than maybe 95% of the population walking around today. And all four don't have to be present, but if all four are present, for sure it's a security. Investment of money. That could be cash, crypto, property, anything of value contributed. Common enterprise means funds are pooled together. Investors rise and fall as one. Expectations of profits, returns, passive income, appreciations, or something else is promised. And then there's based on the efforts of others, meaning based on the sponsor, the operator, or the team. Now, here's the thing. This is kind of like a duh kind of question or statement, right? That someone might ask or say is, does anyone put money in anything that doesn't expect a higher return? No one's putting money into something to get the same amount of money returned. So when people bring stuff to me, and I ask them, it's like, what registrations did you use? What exemptions are you using to be able to offer this private opportunity? And they'll say, well, we don't need to because we're a private company. One, that's a red flag. Two, I hear people come to me, it's like, well, no, they're crypto, so it's not a security. Well, in some cases that's true, but if crypto behaves like a security, then it's a security. I don't know of one person that puts money into crypto that is not expecting an increase in value. So just do the math on that. It's real simple. Bottom line, if all four meet it, then it's definitely a security. One of these could actually trip that also. And here's the thing. When you're in a non-compliant investment, you're probably not legally liable because you're considered a victim. But it's kind of like this. When you've ever played, musical chairs, right? When, you got 9 chairs, you got 10 people circling, the music's playing. Well, when the music stops, 9 people sit down and one person's out and they take a chair away. Well, when it's set up non-compliantly, when the music stops, there's no chairs for anyone. So this is why it's so important that you have enough good sense, enough awareness to ask some of these basic questions. Now, the investment of money, pretty simple. You've contributed something of value, right? That could, again, we said cash, crypto, property, services, anything of value. And bottom line is if that's happening, then more than likely people are expecting some kind of return on that. Common enterprise, this is where you see funds get pooled, whether it's to buy real estate, could be to go into a business operation, a startup, something that's launching. And the investors they share the same fortunes as the operators, as everyone else. They're all in it together. They got shared outcomes, and it's tied to that operator doing the work that needs to be done. Now, expectation of profits, this is kind of one of those, duh, I already talked about this, but you know, the investor is sold on a return, right? When they start talking about getting a return, oh, you're going to get 8%, 10%, 12%, 14%, whatever it is. Now, if you start hearing some really crazy returns, then you got to think, why is this coming to me, right? Wall Street does this professionally, and a lot of hedge funds do this professionally. So, are you going to outplay the professionals that do this 24/7, 365 days a year? Probably not, but there are opportunities that can yield some very high returns that are credible and compliant. This is why you got to be able to ask those questions. Now, when we look at the efforts of others, this is where crypto gets kind of a pass of like, well, it doesn't require the effort of others because they create the technology and then the algorithm and what the people do in the marketplace kind of takes over from there. But again, if it behaves like a security and there is effort of management, it will definitely fall into that category as well. But bottom line is who actually does the work to earn the return, right? If there's a team, there's a single person that everyone's counting on to make sure that this money put into this deal is going to turn into this, meaning like if that person went on vacation and it turned out 6 months, 6 years later, whatever it is, then maybe it wasn't based on the efforts of others. But again, you've got these other prongs to pay attention to. And bottom line is being a passive investor just simply means you contribute capital and wait. Someone else makes the operating decisions. That means that there's a team, there's an individual. Active participating, you're doing actual operating work, not just allocating capital and waiting. So you're in the deal. You're not just an investor. You're more like a joint venture or a partial owner in the overall operations of things. So just remember this. Do not rely on someone else's opinions about this. Do your own homework. Now, again, if all four prongs are met, it's a security. You can argue it all day long. I've had plenty of people that bring me deals, and I've told the people, I said, listen, this is not compliant. And if it has any kind of traction or success, it's probably going to get shut down or it's just going to crash all on its own. And there's a number of things that can be done for a private company. They can register their offering with the SEC or they can operate under an exemption. Not going to go in all the details of the exemptions. This is kind of the world that I've operated in mostly up until we registered a crowd fund with the SEC. But exemptions simply just allow certain measures and certain types of people and certain types of marketing that can be done. And that's what allows these operators. Maybe you see something on Facebook that's, again, a real estate opportunity and they're advertising on Facebook. That means that they have a Reg D 506C that allows them to do general solicitation for only accredited investors. If a non-accredited person sees it, it's fine that they see it. They just can't invest with them because it's illegal based upon the exemption they're operating under. So those are the kinds of things. Now, Reg CF and Reg A kind of changed the game a little bit back when the Jobs Act passed in 2012. It allowed people that were non-accredited. If you were 18 years or older, it didn't matter what your income status was, didn't matter what your tax bracket was, didn't matter what your experience was, you could enter into those opportunities because they've done the basic work that the SEC says they can do. But if it's someone just starting a business, they haven't done any of this, they're doing a promissory note with a bunch of different people, and they're all going to be passive, you're looking at something that's highly, highly risky. So you just got to look for the red flag questions and ask before you wire anything. Banks have gotten really good about this. If you've ever done a wire in recent years, they're going to ask you a bunch of questions. You might get a call to confirm it again, asking you all those questions again, because scams are prevalent with the internet, but they're just prevalent in general. It doesn't matter if it comes in the mail or it shows up on your email inbox. It doesn't matter. Scams are prevalent, and you need to be able to make sure that somebody is compliant. Now, just because someone's compliant, does that mean it's a good deal? Well, no, it doesn't. Businesses fail all the time. It's not, and sometimes it's no fault of the operator. Sometimes things happen. There were businesses that launched in March of 2020 that were dead by June of 2020 because they weren't prepared for shelter in place. They couldn't pivot and become an online company quick enough. So there's a number of things that can happen that are outside of people's control. But at least what is in your control as an investor is knowing the operators did their due diligence, they did the proper compliant paperwork, and they've proven that they're willing to be transparent. Now, Ponzi schemes. This is a big one. Most people don't realize that this is actually named after an individual, Charles Ponzi, back in 1920. And this is basically what happens is when you're paying earlier investors with money from new investors, meaning it doesn't come from real profits or from a real business. It's just money going from this hand to this hand, meaning I entered first and the next investors come in, I get paid. And the same thing. This is what happened with Bernie Madoff. And it went on for a very, very long time, into the billions. I don't have the exact number on hand, but it was definitely in the billions. I've seen others that were just tens of millions. I've seen others that are hundreds of millions. I've known of a few people that brought me something that within 6 to 18 months, they got rated. And so I've seen a lot of these things where it's just blatantly obvious to me when it is a Ponzi scheme. And bottom line is you can avoid this. If you understand the business model, you know how it makes money, then you can understand that, okay, this is how it generates revenue, this is how it generates profit. And you can also kind of pick up on, where are the returns coming from? If they're doing guaranteed returns and it's not a debt security, then there's a good chance it's coming from new investors coming in. And so you got to be able to ask those hard questions. And again, it doesn't matter if it's crypto, real estate, business opportunities, anything. Just know, where is the profit coming from? And that's a simple question that every operator should be able to answer. So, 5 traits that should have you walk away: guaranteed or unrealistic returns. There's vague or proprietary strategy that's explained. Now, listen, companies do have technology that they don't want to put out there front and center. Again, it should be relatively explained in a way where they're not giving out the algorithm for it, whether that's a form of underwriting or that's a form of how they do trades or whatever it might be. It should be in a way that's explained to you, that's not overly sophisticated, and you get the basics of how that strategy actually works. Again, returns paid from new investors. This may not be very blatant. You've got to ask. If they start asking you to go recruit other investors, then that's a no-no. Now, I've been in things where I've referred people. I didn't get compensated for it, but I referred it because I thought it was a good opportunity for people to be a part of. So you need to think about that. Are they offering bonuses? Are they offering other stock and all these different things? You need to be paying attention to those things. When it comes to withdrawal problems, delays, or excuses. Now, this happens even with good companies, whether it becomes a liquidity issue. But if they're saying, hey, your money's locked up for 2 years, there's no way to get it out. Okay, fine. That's not uncommon when it comes to a fund, or there's a penalty to take it out. That does happen. But when it comes time for your anniversary and they talk about it and they can't, and then others start asking and they can't really give you a good answer, then guess what? You probably got into something that was not legitimate to begin with, or unless they've given you some other reporting that gave you other justification. But those are things that come around, or they start pressuring you to invest more. I'm watching this happen real time with a couple of things, and there are going to be people that are going to put more money in because they believe so strongly about it that a little bit more money will help them get over the curb. But it's kind of like, this is kind of visual, but the way they will kind of catch monkeys in the wild is they put a banana in a tree trunk that's got a hole in it, but the hole's not big enough for the banana to come out when the monkey's holding it, and they get smacked on the head. And so sometimes you got to learn to let go of the banana. You got to just be able to walk away from that, that sunk lost cost, and realize you made a bad decision, whatever that is, and walk away and go find the next right opportunity for you. This is a big one. No independent documentation, none whatsoever. And you don't have to have audited financials. It's nice. But there should be somebody with some kind of credentials, whether that's a CFO, a CPA, somebody that is got their eye on the money. Now, sometimes when you have a startup, you got a CEO, a founder that's just starting, and you're going to have to make your best judgment based upon their character, their competency, their resume, those kinds of things. But just know you need to make sure. So if the money flow matters more than the asset performance, then that's gonna lead to danger. So when they start emphasizing all the returns you're gonna get, they're not really talking about how the thing makes money or their strategy or the marketing or how they're doing all these things, then you got to know that they're just trying to get your money in so they can get the next person money in as well. Now let's talk about legitimate paths, a credible investment club. And this is great because this makes you an owner day one. You're not just a passive investor. And it's helped everyday people build real ownership for actually over 100 years. And there's laws around this, there's regulatory around this. It is buttoned up as tight as anything can possibly be. But investment clubs are becoming a new vehicle to bring to market because of some of the other constraints that happen with a lot of things with these other exemptions and other registration processes. So let's talk a little bit about those. So, not all clubs are created equal. A credible investment club is a small group of investors, meaning not greater than 99 people. They pool their money together, they decide on investments together, and they operate under a real legal structure. It's not a sales funnel, right? So you look at a credible club, and there's a formal legal entity. Usually it's an LLC, could be a partnership. There's a written operating agreement. There's real bylaws, so you have real rights. Members vote on investment decisions. There's transparent bookkeeping, as well as member reporting. Limited size, again, typically under 100 members. So that's 99 members or less. And there's no paid promotion outside the investors. They have ownership in the asset, whatever that asset might be. Now, a club that's in name only, there may be no legal entity. The structure may be very unclear. There's no operating agreement, so you have no rights. There's one leader that makes all the decisions. There's vague or missing financial reporting as the operation starts continuing. There's open recruiting, right? Like there's no 99 cap, right? And sometimes a club only has room for 25 or 50 people in it, but 99 is the limit, the legal limit. Then there's the sales pitches and recruiting that, coupled with commissions to go along with that. Those are the things that you've really got to pay attention to. And these are pretty widespread when people really start abusing this, but it is a very credible vehicle for people to use, operators as well as people that want to be owners, but they don't want all the responsibility of the owners. I kind of relate it to, hey, you want to own the asset and you want to get all the privileges that come from the asset, but you don't want to clean toilets. Investment clubs are a great vehicle for you. Now, again, these have been recognized and regulated since 1898, over 100 years. Again, keep it at 99 or less. The SEC has published, an investor bulletin on investment clubs over the years, and what they are and what they aren't, when they are a security, when they aren't a security. So you want to make sure that you're working with an operator that is working with a reputable firm and a technology stack that actually supports all of this so that you are protected as an owner, not a passive investor. So how clubs actually accelerate ownership? For example, capital, becomes accessible because you have a number of people that will contribute a certain amount of money to a project, right? To an entity that's buying a certain project. So you have ownership of that entity has ownership of that project. So let's just say there was a project that was $150,000 and that needed to be split across 50 members. Well, that would be about $3,000 each that people are putting in. And what that does is it makes something that was out of reach for an individual, but combined with a group became accessible. So if you look at land, I live here in North Texas. From me all the way to Oklahoma, acreages of land has been going up in value now, various stages, depending on where you are and what highways you're on and this, that, and the other. But let's say there was an acre of land and it was only $100,000. Now, some people think, well, I can buy land for 5,000. Well, that's in a different part of the country. There's land that goes for a lot more, 1 million an acre, whatever it might be. But let's just say it was $100,000. Well, as an individual, you may not be able to buy that, but maybe you could come in at 3,000 and get a percentage of that acreage, right? So, would you rather have zero, or would you have, let's just say round it up and just say, would you rather have 3% of it, right? If there was your favorite franchise team, like the Green Bay Packers did. Of course, they did a crowd fund, but you had a chance to own a piece of the Packers, right? That you wouldn't be able to own any other ways. You would take a fractional ownership of it, because if the other way means you get zero. So fractional ownership has become the new future, even for the highly wealthy. They do fractional ownership. That's why this becomes so powerful for people. Now there's shared due diligence. You get to look at what's being put under contract before it closes. You get to ask questions, you get to vote on it, and there's obviously a majority rule when it comes to that. So if the majority doesn't want to do it, then guess what? Then the deal doesn't go through. But it also provides better deal flow because sponsors get to take that pooled capital in groups, and they get to be able to create those opportunities for individuals that they would never see on their own, because as a group we can do a lot together. As an individual, some would be able to do none of it. And so I believe in that group dynamic, because leverage is what creates real power and allows things to move quicker. Now, the compounding inside the club, the distributions roll back into the next deal. Yes, there's cash distributions that go to the owners, whether it might be on a quarterly basis, could be on an annual basis. It just depends on how it's structured. But bottom line is, you're an owner and everyone's invested and no one gets left behind. There's not one person making all the decisions. The group is. Think of it as being on the board of directors of a major company. Everyone reports to the board. There might be 5 people on the board, there might be 20 people on the board, but the board is making all the decisions that the executives have to go execute on, and then all the people that work under the executives have to go do the work. This is your opportunity to actually sit on the board, have a seat at the table, and make the kinds of decisions that you would like to be able to make. So before you wire a dollar, you got to run the list, right? Does it pass the Howey test? Right now, our members, they have access to this in their library, so they can go back and review what is the Howey test, what questions do I ask, what SEC exemption is being used if for this type of opportunity, where does the money actually come from, how does revenue get generated, how do the profits come, how do the investors get paid, who controls the funds, can I verify assets independently, meaning can I go look at it, can I see pictures, can I pull it up on Google Earth, what can I see, right? And then what are the real risk? Well, the real risk in any investment should be your investment could go to zero. One of the things I love about real estate is real estate doesn't go to zero. Stock prices can go to zero. We see companies go out of business all the time. Now, the benefit of being in an index fund is index funds don't go to zero, but they can have great years and they can have not so great years or even bad years. But overall, they perform. We just believe that real estate needs to be part of your allocation that you're doing. Maybe you're thinking, I don't have any allocations, right? I'm just getting started. I'm just learning. This is all new to me. I'm getting a drink from a fire hydrant here. I totally get it. This is why in our club, in our community, we provide the education, we provide the awareness, we provide the support. You get documentation to be able to see things, because we know that we'd rather you have knowledge versus operating on emotion. We'd rather you have documentation versus operating on excitement. We want you to have clarity, not be sucked into urgency. Now, do our members get excited about things? Absolutely. But they're doing it from a platform, from a foundation that they can have confidence in. They're making good decisions for themselves or their families. So smart investing isn't about getting rich fast. It's about not getting wiped out on your first deal, which does happen for people. And that's the thing that's kind of hard is I see people that took money out of their house. They took money out of a college fund. Did something, or they took money that they needed to live on because they were thinking they were getting it back in 6 or 12 months. And then that creates a whole other host of issues. So you should only invest money into something that you don't need to live on. And you should definitely understand, how does the revenue and where does the profit actually come from? And when you're new, you need to learn how to ask the right questions. So be in a community where you can ask the right questions, from experienced people, people that actually know, what they're doing. They have a proven track record. Over the past 20 years, we've had two real estate funds. We've done over $45 million in transactions from acquisition to sale. This isn't brokering, though we've done a lot of brokering of transactions of real estate. Our team has done over 200 million in transactions. So we've seen a lot. And being on the capital raising side, I've seen the good, the bad, and the ugly. And what I want you to know is most of it is preventable. Most of it is. And if you're in a community where you have knowledgeable people that you can bounce these things off of, then the sky's the limit for you. If you're in a community where, people are offering their experience, their strength, their hope, their wisdom, all those things, then you're just going to have a lot more confidence faster than anybody else. And over the years, my wife and I have participated in a number of communities that are very high dollar that do not allow 95% of the people to get involved with because they're just such a high price point. So we created something that made it accessible for everyone. That's why we call it the Investor Next Door Club. And we appreciate you being on with us tonight. If you've got questions, the person that introduced you to this, please don't hesitate. You might be seeing this on Facebook. You might be seeing this in the library. You might be seeing this some other way. Get back to the person that introduced you to this and we'll get all your questions answered and show you how we do everything because we did this so the everyday person would be able to move quicker, faster, without putting themselves under a bunch of financial stress. We built what we wish we had 20 years ago when we got started, but nothing like this existed. So we're so happy to be on the journey with you guys. We look forward to talking to you soon. Bye-bye.